Okay, welcome back. So we are at part, I don't know which part this is, but we are talking about the banks now. I hope you have taken the opportunity in this short break to sign up for the Traders Club. The guys will put in the link over and over again. I used to do this live trading event quite a lot. We don't anymore because we can't do it in person live, but we figured out that it might still be possible to do it through Zoom. It will not be on Facebook Live. It will be on Zoom. The guys have just told me that we can't do it on Facebook Live because it's going to lag a little bit. So it is going to be on Zoom only for the first 100, well, no, actually 90 to register because we have some people who registered and also just for our own admin stuff. So only for the first 90 to register. Make sure you sign up for Traders Club right now. Okay, so now talking about the banks. What are banks got to do with the overall economy? It's got nothing to do with banking. It's got everything to do with what the banks think of the economy. So as we know, banks are usually or are very secretive about their outlook of the market. It is their interest. It is in their interest and profits to be secretive. They don't tell you whether they think that the markets are going to be doing great or doing terribly. They always give you that vague answer of where they see the overall movements of the market. But the banks are also the ones who almost make the most money in the market. So how do we know how banks view the economic future? Since banks, I want you to think about this. Since banks make money from interest received by lending money, they will be less willing to lend if they believe there's a likelihood of default. And loan defaults are more likely to happen when the economy gets worse. Right? So I'll go through that again. Banks, how do they make a lot of their money? How do they make most of their money? They make it by lending money and then receive the interest from those loans. But banks don't want to be lending money if they don't think they'll get it back or don't think they'll get repayments or the money back. So they'll be less willing to lend if they believe that there's a high likelihood of default. And actually, a lot of times people borrow money from banks with the intention to pay interest, with the intention to repay the loan. Loan defaults are only very likely to happen when the economy gets worse. So because of these 3 points, we can actually see based on whether the banks are willing to lend, it gives that outlook of whether the banks think the economies are going to get better or get worse. Okay, I'll put it out there again. Banks will be, if they think the economy is going to get worse, they'll be less likely to lend money. If they think that in the longer term, economies are going to be good or better, they'll be quite happy to lend money. On a side note, a real example of this, when the GFC hit, although banks were given money to lend out during the GFC, they actually chose to hold on to those stimulus and not lend it out because they actually felt that while the economy was bad, if they did lend those money out, it would be very, very unlikely that they would get the interest or the capital back. So that's a very good example of banks' willingness to lend and their view of the overall economy. How do you know where banks are willing to lend or not? We look at it through housing data. Think about this. Banks are less likely or will not lend to the developer if they think that the economy is weak. Banks will not lend to the person or the investor if they think the economy is weak. Developers would need to borrow from the bank to build houses. People need to buy houses will borrow from the bank as well. So it all evolves back to the bank, whether they're willing to lend money to the developer to build, whether they're willing to lend money to the person to buy. So it comes down to that 1 point of that house there, whether there's a permit to build. Whether there's a permit to build. So when you look at building permits, this only applies to the US dollar. Building permits are actually permits given out by the or approved by the government for property developers to build. And property developers will only apply for building permits after they have secured funding from banks. So if you see an increase in number of building permits, it signals that banks are more willing to lend to developers because it shows that they have secured the funding from the bank, which also gives you the view that the banks are quite positive about the overall future economy. Building permits have very little to do with new houses, have very little to do with people buying new places. It's got everything to do with how the banks are likely to lend to developers or not. When you see building permit starts dropping, and not just once, but over and over and over again, you can see that it's possibly due to banks being less likely or less willing to lend to developers. And if banks are less willing and less likely to lend to developers, this actually means that their view of the future, the view of the economy in the medium and longer term is not very positive. Remember, building permits applies to the US economy. There are building permits being released for different economies such as the UK, Australia, Canada as well. But in this scenario, we only want to apply this to the US dollar or to the US economy. So this is actually one of the main parts that gives you the insight into what the banks are thinking about the economy as a whole. After banks, what do we have next? We have gross domestic product coming from the government. What is GDP? GDP, gross domestic product, is a measure of the total goods and services produced in a country. It indicates the overall economic activity of the country. If a year-to-year GDP is said to have increased by 2%, this means that the economy has grown by 2% over a year. A growing economy is more likely to have what? A growing economy is more likely to have higher employment, higher wage increases. This actually shows that it's going to be improving as an overall economic activity. But take note, if GDP is growing too quickly, it might actually indicate a bubble. It's not about that big number jump one time. For GDP, you want to look at it as a consistent growth over and over and over again. That's why when we look at GDP, we look at it in the monthly, we look at it in the overall view of things. Okay? I got to pair my numbers in here. So the GDP actually applies to the pound, the euro, the Chinese yuan. Why do I have this? And the Aussie US and the New Zealand US as well. Change this slide. I'll send you a new slide on that. I don't know why it's there. So it's the pound, it's the euro, it's the US, it's the Aussie, and the New Zealand. When you look at the GDP numbers. What you also take note of is when you look at the US GDP, it usually leads all the other countries. The US GDP usually leads the UK, the Australian, and also the Eurozone. So you'll see that if we had good GDP numbers coming from the US, over the next couple of periods, you're likely to see good GDP numbers coming from the UK, good GDP numbers coming from the Australian side. But if we see bad GDP numbers coming from the US, we're going to see bad GDP numbers coming across the board for all other countries as well.